Thanks for tuning in to Saal Mubarak, our annual appointment around Diwali, and the guest who's been gracing the show every year with his presence and intellect joins us again on the show. Ridham Desai of Morgan Stanley needs no introduction. Ridham, great having you as always. Thanks for taking the time out.
Thank you, Neeraj. Thank you for having me on the show. It's a pleasure to be back.
Pleasure is entirely ours. Ridham, I ask with the same question that I ask you every time. Will it indeed be a Mubarak Saal in the next 12 months?
Yeah, I think we are looking in our base case scenario for another good year for equity markets. There are, of course, as usual, many imponderables, and it's certainly not lost upon anybody that the general elections of 2024 will occupy everybody's top of mind recall. And what happens in those elections will probably determine the course of the market in the second half. But I do expect a pretty good first half. The other imponderable is, of course, what happens to the world at large. And the world is going through its own tumultuous phase. We've seen real yields in the US rise and then fall. The Fed seems to have taken a pause. Morgan Stanley's view is the Fed is done. Fed has not explicitly said that, but if it is done, then I think we're probably looking at almost an implausible soft landing in the US. And that does give you a good setup for 2024. So my base case is the market will assume that India will vote in a majority government with continuity, and therefore will actually bid share prices going into elections. And then, of course, what happens in May next year, assuming that the elections happen as per the current schedule, will then decide whether the market continues that or goes through
Okay. So, Ridham,
a volatile phase.
No, please continue. Sorry.
Yeah, no, if the elections produce an outcome that is not in the market's favor, then I think we could get a pretty significant drawdown.
Let me ask him what I wanted to ask. Ridham, so there are two geopolitical conflicts that are going on. It almost seems that it becomes second nature. There is Fed commentary which might have a bearing and some other factors. Oil, not the least important, of course. Would it be safe to say you still believe that it will be a domestic-driven event, namely elections, which will drive or have the most important bearing on markets for this somewhat?
See, Neeraj, India's correlation of returns with global equities have been declining now for a few years. And in fact, India's beta to EM is now down to 0.4, defensive market in the world. And if the world outlook remains fragile, then India, I think on a relative basis at least, will continue to power ahead. The absolute return cannot be exceptionally good if global returns are not good, because remember, India is not a small cap market anymore. It's a large market in the global context. So it cannot really be out of sync with the world. Now, the points that you raised, one on geopolitics, it has to translate into something which matters to the Indian economy, which is oil. So the two of them are closely linked. If the geopolitics is not producing a bid on oil, as we are seeing right now, despite the two unfortunate wars that are happening, it's not like oil prices are surging ahead. They're struggling to make headway, and in fact, they've fallen more recently. So if oil remains range-bound and searches for lower levels, then the geopolitics really doesn't matter. What the Fed does is important, because I don't think the RBI will want to front-run the Fed. So inflation in India is coming into the range. Core is actually quite well behaved. I think some of the food price volatility will ebb as we get into the winter months. So even the headline inflation will look pretty okay. But I think the RBI will wait for the Fed to signal that it's done before it actually acts on interest rates on the downward side. Now, that said, because India's growth is quite good, I think the RBI will continue to err on the side of caution and not attempt an aggressive rate cut. So that's the impact of what the Fed does. The third aspect, which you didn't raise, is what happens to global growth. Now, China is showing some recovery of growth, but all eyes on the US. can the US escape this steep rise in interest rates with a soft landing? History suggests that doesn't happen. And given the nature of the rate hikes in America, the equity markets and the bond markets until recently thought a recession is almost invariably going to happen. Of late, the markets seem to be getting a bit more relaxed. And if the Fed does engineer a soft landing, that I think will make the global backdrop quite good for India. So that's how I would analyze the global factors. And then going back to your question, therefore, we come back to domestic events, which will still account for bulk of how India performs. And within that, of course, earnings, which I think will look pretty good, at least in the next 2 quarters. And then elections, which we discussed, but we can go into greater detail.
Yeah, we most certainly will. And I read your note with interest that you are ahead of the consensus when it comes to Q3 earnings, and Q2 thus far has turned out to be a good one. But allow me to come to that in just a moment. Just a point before that, a follow-up to the points that you made, Ridham, is if global growth peters off and looks a lot more worse off than what people are anticipating right now, never mind the rebound in China, does it impact equity sentiment generally, and therefore India gets impacted as well? Or could India be the first favorite amongst many others simply because it will probably be the best performing large growth market in the world?
Yeah, that's exactly, I think, how it pans out, Neeraj. So you're spot on. The relative case for India remains strong. The absolute returns will start looking less attractive, as they have been for the past few months. I mean, it's not like the markets have done a hell lot since last Diwali. But, in the context of what the world has done, the Nifty is looking very good, and that continues to be the case. India is attracting long-term capital allocation. What investors are struggling with is the headline valuation. And that, I think, is the conundrum of a market that has strong earnings growth. The multiples will not just come down like that. It will need a crisis for the multiple to come down. And then what happens is when a crisis actually hits you and stocks become cheaper on a headline basis, nobody wants to buy them. So that's the conundrum of rich multiples. In fact, I don't think the multiples are that rich. I think the market is not oblivious to the medium-term earnings potential of India. And therefore, stocks will not ordinarily become cheap on, a P basis until you get an event which rattles the market's sentiment. So on a base case basis, if the world is struggling, then India does well on a relative count. And if the world makes a bit more progress and if growth starts stabilizing and rates have peaked, then I think India will also make an absolute upside case.
Got it. One more small factor, Ridham, you probably have the best pulse on this one. If Chinese growth as well as the US-Chinese relationship sees more evidence of the thawing that we kind of maybe hearing about, or the sound bites are such, does it lead to flows into the Chinese markets which move away from other emerging markets like India? Is that a risk to flows, global flows?
Actually, see, I think this is a much debated subject and it's almost overanalyzed.
Okay.
India does not compete with China for flows. India does not compete with China for flows, in my view. The EM basket has been struggling in large part because of China, and EM has not been getting flows. So the EM-related flows into India have continued to remain weak because unless EM as a basket receives flows, India will not get its fair share, or even less than its fair share. I mean, India is not a small EM market. It is amongst the biggest EM markets. So for India to get EM flows, the EM sentiment has to turn. So ironically, if China starts doing better, and if that causes sentiment towards EM to do better, then flows into India will improve. They will not actually deteriorate. They're already bad, actually. So, there's no case here for them to deteriorate. You made another Another point about the thawing of the relationship between the US and China. Now, I think, there, the structural story is that the multipolar world thesis that Morgan Stanley has been talking about for quite a few years now is very much entrenched. This thesis is about multinational companies seeking newer markets for production and for consumption. And India is extremely well placed globally, as we discussed last year following our blue paper on this count, both in terms of its consumption potential as well as its ability to deliver large-scale manufacturing. India will find favor amongst MNCs for further investments. That is not going to change even if there is a slight shift on the US-China front. So China doing well is not a bad thing for India.
Okay, got it. I was going to save that point for the last, and I will come back to that too. Now to the 2 points that I really wanted your view on, and you mentioned both of them. First, earnings. I heard you make 2 points, that earnings might be good for the next 2 quarters, or maybe quarter 2 and quarter 3 at least, at the very least, or maybe quarter 3 and quarter 4. And I heard you say that you are pretty sanguine about the earnings prospects, not just for FY24, but in the years ahead as well. You are great with numbers, Ridham. Can you tell us a bit about this?
Yes, so see, Neeraj, the earnings cycle began sometime in the depths of COVID. And it was triggered by a shift in government policy that now favors corporate profits compared to the previous years. So we've seen a lot of reforms, including GST, Real Estate Regulation Act, the cut in corporate tax rates, production-linked incentives, which are all pointing towards better corporate profits. The theory here is that if corporate profits are better, then they will invest, and if they invest, they create jobs, and that leads to greater prosperity. So overall economic growth starts improving. What has happened in the previous decade is that a large part of it was lost because corporate profits were declining, companies were deleveraging, coming out of the excess investments that they had seen in the start of the previous decade and prior to that. All that has now got flushed out. So we're looking at corporate balance sheets in India, which are very light, a policy environment that favors earnings, and therefore the share of profits in GDP, which were at about 2% in 2020, now at around 5%, I think will go past its previous high and head to say maybe 8% over the next 3 or 4 years. Now, for a GDP that's posting at least 10% nominal growth, that means corporate profits in India could be compounding at 20%. And this is the point I make on valuations, is that when you have earnings compounding at 20% for 3 or 4 years, buying stocks at 20 times earnings is really not rich. In fact, it would actually make India look quite attractive because there aren't that many places on the planet which have that type of growth that's coming. So the earnings outlook, I think, on a medium-term basis remains good. The short-run earnings, I think, also looks good. This quarter will be quite strong. I mean, the quarter ended December, which reports in January, will be quite strong for many reasons, not excluding the delay in Diwali because of Adhik Maas in the previous quarter, the cricket World Cup and other factors at play. So we should actually end F24 on a pretty good note. Then I think the election outcome may have some bearing on how earnings shape up, because if there is an adverse election outcome, then there may be some restraining of corporate sentiment and investment spending, which may then start affecting earnings in F25. But if the election outcome is in line with what the market, I think, wants, then I think we should be good. F25 will also be another strong year.
Okay. So that's the word on earnings, viewers. Maybe 20-25% growth, whatever the number is, but for a number of years is how maybe people should look at what could happen over the next many. Ridham, you mentioned elections, and you kind of have shown the hand of what it would mean for the market. Could there usually I mean, there was a Bloomberg story which spoke about how each of the last 5 general elections, there has been a run-up to in the markets into the date. Now, there are some 5 state elections that we are already underway with. If those election outcomes are slightly better than what the market is factoring in right now, or some quarters of the market may be factoring in as we speak, and if there is a pre-rally or a rally immediately post the state election verdict as well, you still anticipate the first half of the year, led by earnings and the seasonal run-up, to be positive?
So, Neeraj, I think the state elections may not have much bearing on how the market behaves.
Okay.
I can give many examples of how the state elections do not have predictive power. In 2018, the NDA or the BJP lost the 3 Hindi heartland states and yet swept them in the general elections. Exactly the opposite had happened in 2003-4. So I don't think they have great predictive power. The market will probably get a little bit volatile around these election results and then continue to make headway. Again, the context here is that I'm not assuming any upheaval in global markets. So keeping that aside, India, I think, will continue to make headway. The market, as you rightly point out, if you look at the past few elections, going back all the way to the 90s, has a tendency to be positively biased unless some really strong evidence emerges that there's going to be greater polarization. So if the opposition alliance, which calls itself as INDIA, demonstrates that its ability, that it's able to share seats and create a united opposition and therefore make the election outcome less predictable, I think that's the only case for the market to not trade higher going into May of next year. Otherwise, my base case is that the market will assume that India will get continuity and India will get a majority government. And then it will see what actually happens and then accordingly trade the actual election results. If it comes in line, the market will actually correct a bit because, you buy the rumor and sell the news, right? But if the election results happen to be totally in contrast to what gets priced in, then I think, then we'll be in trouble because then I think the 2004 template works. The Nifty fell, double digits on a single day then. And I think this time around the fall could be even more dramatic. And we could be looking at a serious drawdown in share prices. So that's how I think about the elections.
Got it. Ridham, just one added question to this. Corporate capex selectively, and you've pointed this out to me so many times with numbers, as you do, about how there are telltale signs of things having picked up. But an aggregate, corporate capex hasn't quite been up there to my mind, and please correct me if I'm wrong. Do you think it's a factor of global growth looking a bit anemic? Or is it also that corporate India might be holding back for seeing what's happening in the elections before they put hard money to work?
It could be a combination of many things, including the 2 things that you suggested. It's also because there is still capacity in the system which is getting exhausted. So companies will tend to make investments depending on the lead time to setting up capacity, depending on how their capitalization shapes up. So I think there are many factors at play here. But on a scattered basis, I think corporate capex is already showing signs of a revival. And we will get more and more signals going into the next 6 months. There could be a setback if the country chooses a minority government and a change in government. But that, I think, is not something I can predict very well. So in my base case, again, I think we are in the midst of a recovery in capex that could last for a few years, led by private investments. Just remember that the government has spent money counter-cyclically on capex quite aggressively. In fact, surprised all of us, including me, that they chose to spend on infrastructure capex in the previous budget, which was the last budget before the elections. The tendency of previous governments has been to spend on subsidies and on supporting consumption spending rather than infrastructure capex. And I think this shows the mindset of the current government that we need to have the capex in place in order to have more sustainable growth. So this counter-cyclical capex may continue until the corporate capex spending becomes more entrenched. And then it will give way for corporate capex spending, and the government can retract some of the spending that it is doing.
Got it. Ridham, last 3-4 minutes onto the show before we wrap up. So you've laid out that the triggers are largely domestic in nature amidst all that's happening globally. You've told us that you believe earnings growth would probably be stronger. Where do you reckon will we see a combination of both earnings growth as well as markets rewarding the performance? Because currently, and as is always the case, but there are some which are getting rewarded disproportionately high on valuations because they are delivering earnings, and some like banks are not quite getting rewarded despite the fact that the earnings growth has stayed relatively stable.
Yeah, I think that's also because there are technical factors that come into play when you look at the markets on a shorter horizon. So ownership matters, incremental bid matters. And in the banks, I think the incremental offer has been larger than the bid because of the extent of ownership, especially with foreign portfolio investors that they have long held in banks. So I think they're diversifying their portfolios now, and therefore banks are getting more offers from them. That I think may shift as a template going into 2024. Fundamentally, I think the banks have hurt because of pressure on NIMs. And I don't think the market is completely convinced that the NIM pressure is over. We think that the worst of NIMs is getting behind us. We think credit growth will remain quite good. The only one imponderable is the extent of credit losses that may come on some parts of the retail portfolio. I don't think it's going to be a very major thing. So there may be a scattered losses in some of the unsecured personal loans. But we are very, very far away from any protracted build-up in credit losses. So I think the template for bank earnings look good. The large cap private sector banks are actually trading quite attractively on valuations. And in many of the cases, this is the cheapest that we've got them at in many years. So they are, I think, going to see an inflow of domestic money where the ownership is not as large as it is with foreigners. And I think as soon as this bid offer hits tilt, I think you will see the share prices perform. So I would still back financials quite heavily going into 2024. And even though you've not asked me, I think the other place where things look quite good is consumption. Household balance sheets are leveraging. They are spending their future income. It's something that India has not seen in the past. It's a trend that I think will continue to persist over the next few years. India is breaking out in terms of per capita income from this $2,300 mark, where a lot of the basic consumption tends to peak out in real terms. Basic means roti, kapda, makan. That tends to peak out. Incremental income will go into discretionary spends of all kinds. So I think consumption is a good theme. And we already discussed investments. I think industrials also will continue to find favor. So that's how I think about the sectoral outcomes in the market for 2024.
Got it. Ridham Desai, before we wrap up, one unusual prediction or any number or any statistic or any event that you're looking forward to for the next 12 to 24 months?
I think I'm hoping that we do not get any upheaval in the election outcome, which derails India's macro story, because India is in a very sweet spot. It's rising in the global order. It is the destination for a lot of MNCs and for a lot of global investors. I converse with a lot of them, and in fact, my meetings and conversations are at all-time highs. So it just tells you about the interest that's there. And if there is no upheaval politically, then I think we're set for a golden period in India's performance, both on the macro as well as the stock market.
Boy, I wish I had more time to talk about the China Plus One thing, which we spoke about earlier, but haven't quite managed to tap Ridham's brains on it. But maybe we'll save that for another time. But Ridham, to you, family, the team at Morgan Stanley, and everybody around, from all of us here at BQ Prime, wishing you a very happy Diwali and a prosperous New Year. And please keep on coming on our shows to give us your wit and wisdom.
Thank you, Neeraj. And I will also extend my warmest wishes for the upcoming Diwali season as well as the upcoming New Year. And I hope everybody has a very, very prosperous time ahead.
Thank you so much. Really appreciate you taking the time out today.
Thank you.
And viewers, thank you so much for tuning in.